Kiplinger.com posted a series of articles over the past few months that discussed the retirement tax bomb. A tax bomb is a huge tax bill that may be lurking in a retiree's tax-deferred accounts. This bomb goes off after you turn 72 years old and are required to take money out of your tax-deferred accounts each year. In this video, we will look at an example of a retiring couple who will be facing this tax bomb if they do nothing about their accounts. We will then look at two strategies that can be used to defuse the tax bomb. First off, let me say that I don't think tax bomb is a good name for this issue. It is more of a tax mountain. This diagram shows the mountain that future tax payments our example couple will be facing. The blue shaded area represents a retiree's annual taxable income by year. It looks a bit like a blue mountain, not a bomb. In this example, our clients are able to retire early at age 60. They will then have 10 years of low taxes until the elder of the couple begins Social Security payments at 70. The next bump up in their taxable income arrives when he turns 72 and begins his RMDs. Then the tax mountain increases again once the younger spouse turns 70 and then 72. From age 74 onwards, they will be receiving all their retirement incomes each year, and the mountain continues to grow. At age 86, the mountain passes the orange line, which means their income would be high enough to move them into the 28% federal income tax bracket. Now, let's take a look at some numbers to get an idea for how steep this tax mountain really is. Here we're looking at a projection of their taxes by year. In the first 10 years of retirement, their total annual tax will be around $12,000 per year. This is due to their investment income in their brokerage accounts, income such as interest, dividends, and capital gains. In 2032, we see their taxes begin to increase. This is the year when Social Security and RMD incomes begin to have an impact. In 2036, when they are 74 and 72 years old, they will both have Social Security incomes and both will be taking RMDs. Their tax payment that year will be $97,000. At age 80, they'll be paying $145,000, and by age 90, they'll be paying $270,000 a year in income taxes. That amount is nearly as much as they are making now at the end of their careers. And that number is a big jump from the $12,000 in taxes they were paying in the beginning of their retirement. What if there was a way to reduce this large bill that is coming later in life? A way to diffuse the tax bomb, so to speak. A way to decrease the slope of this tax mountain. This is a great example of the type of issues we work on here at Andrew Marshall Financial when we do a retirement withdrawal plan. Let's look at two things we can do to lower their future tax bill. The first is asset location, not asset allocation, which is usually discussed. Here we are talking about location. What investments are in what account types? Proper asset location means rather than owning all asset types in each account, you are better off owning stocks or bonds in certain account types based on the tax consequences and based on the growth rate. Slow-growing assets like bonds should be owned in your tax-deferred accounts and faster-growing assets in your Roth accounts. Vanguard claims proper asset location can improve returns by up to 0.6% per year. The other strategy for lowering one's future tax bill is to do Roth conversions. Our example couple will have 10 years of very low income taxes. If they convert the investments in their tax-deferred accounts to Roth IRAs during these years, they could get their money out of the tax-deferred accounts while paying a lower tax rate than if they wait until they are required to take the money out. They are in a perfect situation for converting some of their tax-deferred investments while they are in the lower tax brackets. Essentially, they will be pulling their future taxable income forward and paying a lower rate by doing so. Let's look at an example of the financial benefit of the Roth conversion strategy. Here is the blue tax mountain we looked at earlier. If we adjust this slider to fill up each tax bracket, we can see how much of an impact doing Roth conversions will have on the ending portfolio value and on their future income tax bracket. Roth conversions to fill up the 10% bracket has a small impact. If we increase the conversions to the current 12% bracket, we can see there is a larger benefit. The peak of the mountain no longer crosses above the orange 28% cutoff line. With conversions up to the top of the 22% bracket, we can see an obvious difference in the projected taxes. The green area is with conversions and the blue is without conversions. Their taxable income will be more consistent and lower overall by doing the Roth conversions. On the right side, you can see the significant increase to their portfolio value. Not everyone will see this large of a benefit from Roth conversions, but it is a strategy that is definitely worth investigating.
I'm Andrew Marshall. If you enjoyed this video, please subscribe or give it a thumbs up. If you have any questions or comments, please leave those below. I plan to do more of these videos in 2023, so until next time, see you later. Thanks for watching.